In December 2025, California's Insurer of Last Resort held 668,609 policies and $724 billion of exposure. Since its October 2023 peak, Florida's equivalent shed more than 1 million policies as private carriers came back. Same peril, two opposite regulatory answers, and so far only one has produced a working private market. Right now, a 1% assessment is being collected on Florida property policies to pay for an insurance company that failed in 2023. Neither state asks the people paying whether they chose the risk. The open question is which answer survives a season that empties a backstop. You are watching Macro Frontier. Macro Frontier. The pool grew 146% between September 2022 and December 2025, and its exposure grew 230% over the same window, though coverage limits rose in that period too, with commercial cover reaching $100 million per location. State law places the plan behind 118 admitted insurers and 132 surplus lines writers, and only the admitted insurers can be assessed to cover its losses. For every 2 new or renewed Fair Plan policies issued between 2020 and 2023, California Department of Insurance records show only 1 wraparound difference in conditions policy was purchased. In each of those years, the department counted roughly 115,000 fewer wraparound policies than Fair Plan policies, leaving basic fire cover with no protection against water damage, theft, or liability. Contrary to common assumptions, department data indicates that 75% to 80% of policy non-renewals were initiated by policyholders rather than insurance carriers. When primary market rates fail to reflect loss expectations, policyholders migrate into state residual pools, transforming a temporary safety net into the primary risk holder for high-peril property. Florida's Citizens Property Insurance Corporation moved the opposite way, dropping from a peak of 1.42 million policies in October 2023 to 395,337 total policies in force by 31st of December 2025. Total exposure stood at $128.5 billion, with personal residential policies accounting for 389,157 of the total count. Private carriers assumed more than 428,000 policies through statutory depopulation programs in 2024, followed by more than 546,000 policies in 2025. As capital returned, Citizens recommended a statewide average rate reduction of 2.6% for personal lines in December 2025, with 3 out of 5 policyholders receiving an average decrease of 11.5%, or $359 per policy. Comparing December 2025 totals shows California's residual pool holding 1.69 times the policy count of Florida's backstop. This divergence illustrates how state statutory rules dictate whether catastrophe exposure concentrates in public pools or redistributes into private insurance markets. Macro Frontier provides institutional analysis on structural financial shifts. The expansion of California's residual pool is driven by a structural delay between rate filings and regulatory approvals. Historical filings show that in August 2021, the Fair Plan indicated a required rate increase of approximately 74% and filed for 48.8%. The California Department of Insurance approved a 15.7% increase in September 2023, 2 full years after submission. Similarly, in September 2025, the Fair Plan indicated an 80% rate requirement and filed for 35.8%, which remained pending as of January 2026. Because approved rates remained below indicated loss requirements, private insurers restricted writing high-risk property, leaving the Fair Plan unable to price policies out of its portfolio. Under California Insurance Code, the Fair Plan cannot retain earnings or accumulate capital reserves. When major catastrophe losses occur, unfunded liabilities pass directly to participating admitted insurers. Prolonged regulatory rate lags cause private capital to withdraw, shifting structural risk into uncapitalized state pools. Catastrophic events test this uncapitalized backstop structure directly. Following the Eaton and Palisades wildfires, The FAIR Plan processed approximately 5,400 claims and paid out roughly $3.5 billion by January 2026. Because loss claims exceeded internal funds, the plan issued a $1 billion assessment on admitted property insurers in February 2025. This marked the first major assessment since smaller levies of $150 million in 1993, $60 million in 1994, and $50 million in 1995. Under state regulations, admitted insurers may recoup these assessments from their own policyholders through temporary supplemental fees, subject to prior approval from the insurance commissioner over a 24-month window. Historical analysis by the Assembly Insurance Committee described such assessments as an indirect tax on property owners across the state. When residual pool losses surpass reinsurance limits, financial recovery mechanisms automatically pass the deficit to general policyholders who did not originate the underlying property risk. Florida's policy count reduction reflects legislative restructuring of litigation rules and depopulation mechanisms. According to reinsurance broker Gallagher Re's aggregation of NAIC statutory filings, Florida property specialists recorded a weighted average combined ratio of 81.8% at year-end 2025, improving from 104.2% in prior periods. The subgroup generated $1.2 billion in net underwriting gains, increasing specialist policyholder surplus by 34.9% to $8 billion. Total statewide policyholder surplus expanded 25.7% to $16.4 billion across the industry. Underwriting profitability was achieved by 46 out of 61 reporting carriers, encouraging 17 new property and casualty insurers to enter the state market since reforms were enacted. Lower litigation expenses enabled private carriers to absorb over 546,000 policies from citizens in 2025 alone. Statutory reforms that align premium pricing with claim litigation costs can successfully restore private underwriting profitability and pull policy volume out of state-backed residual markets. While depopulation successfully transferred 546,000 policies out of citizens in 2025, long-term stability depends on whether private carriers maintain solvency through major storm cycles. Statutory consent orders require assuming carriers to provide comparable coverage terms, but regulators do not publish aggregate post-takeout datasets tracking actual renewal premiums or coverage modifications. Policyholders who decline depopulation offers face higher citizen surcharges, effectively nudging volume back into the commercial market. Citizens' recommended rate reduction of 2.6% in December 2025 reflects reduced exposure and improved risk metrics following 2 consecutive depopulation years. However, when private carriers assume residual policies, household coverage continuity relies entirely on the capital reserves of private specialty insurers. If private balance sheets lack sufficient capital to absorb severe hurricane seasons, depopulated policyholders face potential insolvency risks and secondary market disruptions. The backbone of Florida's insurance market is the Florida Hurricane Catastrophe Fund, a state-operated reinsurance mechanism. According to the fund's claims-paying capacity report published on the 21st of May, 2026, the statutory reimbursement obligation for the 2026-2027 contract year is capped at $17 billion. The fund holds projected year-end liquid resources of $14.33 billion, comprising $12.08 billion in cash reserves and $2.25 billion in pre-event bond proceeds. Post-event borrowing capacity over 12 months is estimated at $7.1 billion, bringing total estimated claims-paying capacity to $21.43 billion. This provides a $4.43 billion buffer above the statutory obligation for a single hurricane season. However, liquid cash covers only $14.33 billion of the $17 billion limit, leaving $2.67 billion that must be funded through post-event debt issuance if losses reach the statutory cap. The catastrophe fund maintains adequate capacity for one catastrophic event, but relies on debt markets to fulfill its statutory commitment. The vulnerability of Florida's backstop lies in consecutive hurricane seasons. The Catastrophe Fund's official report calculates that if the $17 billion limit is fully exhausted during the 2026-2027 contract year, estimated capacity for the 2027-2028 season drops to $12.78 billion. This represents approximately 75% of the statutory limit, creating a $4.22 billion structural shortfall in the subsequent year. In addition, the fund continues to carry $8.01 billion in reserved losses from prior events as of March 2026, including $7 billion from Hurricane Ian and $1 billion from Hurricane Milton. Repaying $4.92 billion in post-event bonding costs requires levying a 0.73% emergency assessment on state policyholders for 10 years. While the Catastrophe Fund survives a single major storm, multi-year loss events rapidly deplete liquid reserves, forcing the state to issue debt and impose long-term assessments across all property lines. When state backstops experience capital shortfalls, assessment mechanisms shift the deficit onto general policyholders. Under Florida Statute Section 215.555, Catastrophe Fund emergency assessments are capped at 6% of premium in a single year and 10% in aggregate across property lines. Concurrently, the Florida Insurance Guarantee Association handles claims for insolvent carriers through separate statutory levies. Following 4 assessments since 2021, the Guarantee Association continues to collect a 1.0% emergency assessment triggered by the April 2023 liquidation of United Property and Casualty. This assessment remains active through 30th of September 2026. As a result, every Florida homeowner paying property insurance today contributes to liquidating a carrier that failed 3 years prior. In California, fair plan assessments of $1 billion on admitted insurers are recouped via supplemental policy fees. Both regulatory models ultimately transfer residual pool deficits onto households that never selected the underlying property risk. The final transmission channel of catastrophe risk reaches household balance sheets and mortgage markets. Under Fannie Mae Selling Guide standards, property policies issued by state fair plans or windstorm pools fulfill conforming mortgage eligibility requirements. Homeowners in residual pools remain fully eligible for institutional mortgage financing, keeping the credit channel open. However, rising premium rates and mandatory state assessments increase total debt-to-income ratios for policyholders. In California, fair plan exposure of $724 billion across 668,609 policies creates potential assessment liabilities for general admitted market policyholders. In Florida, emergency assessments of up to 10%, combined with Guarantee Association surcharges, add fixed costs to property ownership. Whether state intervention relies on artificial rate caps or statutory depopulation, unpriced catastrophe risk is ultimately reallocated back to households through non-voluntary fee structures. Structural divergence between state property insurance models will accelerate as climate exposure and reinsurance costs escalate. California's rate approval delays risk expanding its residual plan beyond $724 billion, deepening potential assessment burdens on admitted insurers. Florida's depopulation strategy has successfully restored private underwriting profitability, but leaves the state catastrophe fund vulnerable to multi-event exhaustion. If a severe season depletes the fund's $14.33 billion in liquid resources, secondary capacity will fall to 75% of statutory limits, triggering long-term policyholder assessments. Both states demonstrate that suppressing market rates or ceding risk to state pools cannot eliminate loss exposure. It merely determines which households pay the ultimate bill. Next, the industrial capacity America cannot rebuild in time. This analysis was produced by Macro Frontier. Subscribe for structural macroeconomic intelligence. The data does not care whether you are watching.